What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, I'm going to be talking about how to start investing for beginners. I've gotten a lot of feedback from people close to me that some of the videos are just a little bit too complicated, so I'm trying to dumb it down and go back to the basics here for anyone that might be interested. In particular, in this video, we're going to be talking about the 3 key decisions that you need to make in order to start getting invested in Canada. I should copyright that. In particular, we're going to be talking about the difference between a financial advisor, a robo-advisor, and a self-directed account. We're going to be going over the registered tax savings account, so that's the TFSA, the RRSP, and then I'll touch a little bit on a margin account and what that is, although probably wouldn't recommend it at this time, but we'll talk a little bit about it in a sec. And then after that, we're going to be talking about how to assess risk tolerance and your asset mix, or where you should start. So before we get started, I'd just like to let you guys know that over 90% of you guys who actually watch this content aren't subscribed to the channel. If you guys are interested or do enjoy this content, please at least consider subscribing, and I hope to see you guys in future videos. All right, let's go ahead and jump into this video. Okay, so the first main decision you're going to likely have to make is whether you want a financial advisor or not. The main decisions as to why you would want a financial advisor are mainly because of their knowledge, their behavioral influence, their experience, their professional tools, and also the time saved that you would have to be doing on research if you were self-delegating your account. Since most financial advisors are certified, they often have many years, if not decades, of experience and have often invested through many bull as well as bear cycles in the markets. And that experience is very essential for someone who is a beginner and has no knowledge or no prior knowledge of investing. They've also likely worked with several different types of clients who have several different types of needs, and investing takes, at least a minimum requirement of knowledge into what you're doing. Most advisors have gone through extensive studies to get to where they are, and often their knowledge can't be duplicated as it's been gained through experience. Now, that being said, financial advisors come with their cons as well, so let's just run through that list quickly too. The main cons of going with a financial advisor, number one, would be the costs. You're likely going to pay more to have someone tell you what to do with your investments rather than doing it yourself. So you're relinquishing the responsibility of your financial future, and it's going to probably be more expensive. Number two is it's likely difficult to find a good one. In my experience, it's all about trust. You have to find somebody that you trust and that you believe in, and make sure that they don't have a conflict of interest, okay? Because in most cases, the more you invest through them, the more money they are making off of you. The main examples where you could find these people are, BMO, RBC, TD, all the main banks in Canada. Essentially, there's also many boutique firms. One in particular that I've done business with in the past is Edward Jones. Okay, let's talk about the second option. The second option would be going with a robo-advisor. And the main pro of going with robo-advisors is the low cost, okay? There's no minimum balance requirement, and you can just start simply by pressing on, a button on your phone and giving them your information. The con of going with a robo-advisor would be that there's no human interaction, and it's pretty much a one-size-fits-all solution. Now, you can't discuss the special needs of a child with an online app, for example. You can't discuss aging parents' need for an online app, and the risk tolerance assessment is not so great. The one-size-fits-all solution isn't really great for everybody, but for certain people who typically have under $70,000 worth of capital, this might be an option for you. The main example of a robo-advisors in Canada would be Wealthsimple. Okay, now the third option would be to go with a self-directed account, and you can do this at any major bank, any boutique firm, but the main example of a self-directed account that I would use in this video is Questrade. The major pro of going with a self-directed account, again, is that it's going to be lower cost than going through a financial advisor, and you get 100% freedom to do what you want with your capital allocation. There's nobody telling you what's right, what's wrong, and if you know what you're doing, this can be highly advantageous. The main con of going with a self-directed account, number one, is emotional bias, okay? You kind of don't have that buffer between you and the market to tell you that you're completely biased in your opinion here. You're also going to have to do everything yourself when it comes to research. You have no army of analysts that you would have at, let's say, a boutique firm or at a bank that would be doing this research for you and telling you what is over or undervalued. And the third major con is that you might have a lack of knowledge. You may not fully understand how to assess your own risk. You might not understand the different order types that are out there. You might not understand various investment strategies, whether it's dollar cost averaging, dividend reinvestments, anything along those lines. You might not understand what the asset allocation mix and how to optimize that for yourself. You might not understand foreign exchange rates and how that works if you're a Canadian looking to buy US stock. Finally, you might not fully understand how to value companies. The first decision you need to make financial advisor, robo-advisor, or self-directed account, and make sure you choose wisely. Okay, so the second main decision that you're going to have to make is what type of account do you want to open up, okay? And there's two main registered accounts in Canada which are tax-free or have tax benefits, and that is the TFSA and the RRSP. In general, the TFSA is a little bit more flexible than the RRSP because the RRSP is meant to be like your retirement fund. Once you retire, then you start getting paid out of your RRSP, and your RRSP has accumulated, capital gains and dividend income over the life cycle that you've invested into it. But the TFSA is a little bit more flexible just because you're able to deposit and withdraw without actually incurring any tax. So let's just quickly talk about the TFSA first. The TFSA program was created in 2009 for individuals who are 18 or older and have a valid social insurance number. You can create a TFSA by reaching out to your financial institution. They're going to likely ask you for some sort of documentation, a form I believe that you need to fill out from the CRA, and then you can basically go ahead and start contributing. There is a defined contribution amount for the TFSA each year. You can find those on the CRA website. Generally, the types of investments that are permitted in a TFSA are the exact same that are permitted in a RRSP account, and that is going to be cash, mutual funds, securities listed on a designated stock exchange, guaranteed investment certificates, which is kind of like a bond, bonds, and then certain small shares of business corporations. Ultimately, if you're looking for flexibility, I'm going to 100% be recommending the TFSA over the RRSP. Okay, so if there's any Americans watching this, the RRSP account is very similar to a 401k. It's a savings and investing vehicle that is designed for employees as well as people who are self-employed in Canada. Pre-tax money is placed into an RRSP and grows until it is withdrawn, at which point is taxed at your marginal tax rate. The main difference between an RRSP and a 401k plan in the US is that your unused contribution room can carry over year to year in Canada, whereas in the States, it cannot. The contribution limit to your RRSP in Canada for 2020 was 18% of your gross salary, capped at $27,320. This is the number for 2020. Typically, it rises over time. These amounts are set by the CRA. Now, the difference is a 401k plan allows a maximum contribution of $19K a year, and that increases to $25,000 when you turn 50. Similar to a TFSA plan, you simply need to reach out to your financial institution or your employer to start or set that up, and they will likely ask you for some documentation proving you are who you are and to fill out some forms from the CRA. And like I said, you're not going to be taxed on this money unless you withdraw it. In general, people invest into their RRSP until they retire, at which point it becomes an income fund and starts paying them in the retirement. Okay, the last account to cover is the margin account or the individual account. First things first, do not open up one of these if you have not maxed out your contribution room in both your TFSA and your RRSP. Okay, the reason being is individual accounts are not tax protected. If you're able to tax protect your money, why would you not want to do that? Make sure you max out the contribution in your TFSA and your RRSP before investing into one of these. Now, margin accounts, you're able to borrow money to amplify your returns, but what this does is if you make a wrong bet and you're actually losing money, it's going to also amplify your losses, okay? So be careful when borrowing on margin. In fact, I wouldn't recommend it to any beginner investor. This is simply for the advanced investors who believe they have a high probability of being right in the trade that they are making. Margin is your best friend until it isn't, and that's the best saying I've heard about these types of accounts because you don't want to be on the hook for borrowed money paying interest when you made a bad bet. So the third key decision that you're going to need to have to make is determining your own risk tolerance, okay? And ultimately that's going to feed into your asset allocation or your asset mix. You need to understand how much risk you're willing to take and which type of risk troubles you. Your risk tolerance is essentially the degree of uncertainty that you're willing to take on in order to amplify your returns or increase your returns. And it's determined by a combination of factors, including your investment goals and experience, how much time you have to invest, your other financial resources, your fear factor, and ultimately your income. Okay, so here's just some questions that a financial advisor might ask you, or some questions that you might want to ask yourself when determining your risk tolerance, okay? So are you more concerned about losing money or losing purchasing power? How much money are you willing to lose? How worried do you think you would be in a severe market decline? What kind of investments might keep you up at night? Do you intend to track your investments daily, which is possibly an indication of unease? And how varied do you want your portfolio to be? These are questions that you need to answer in order to determine your risk tolerance. There's obviously many ways to manage your risk. The number one way that you've likely all heard of before is diversification, and that's where you allocate, money to various types of buckets so that if one asset class goes down significantly in a market crash, you at least have a balanced portfolio so that you don't see it all come down all at once. You don't have all your eggs in one basket. Another strategy is dollar cost averaging, and this is purchasing a specified amount of stock over a period of time and averaging out your purchase price. Okay, so for instance, if you're, let's say, investing in something extremely volatile, for this video, I don't know, let's just use something like Bitcoin because it's crazy volatile. If you have, let's say, a certain amount of money that you want to invest in Bitcoin and you invest in increments over time, as you see it's going up crazy huge right now, and then it actually declines, so you end up losing lots of money in a small period, you still have money to continue investing into it to lower your average purchase price and ultimately help you increase those gains over time if it goes back up. Okay, so now when we're talking about asset mix and asset allocation, your goal is to optimally balance your portfolio to minimize your risk and increase your chance for potential returns. And I know that's a lot easier said than done. Essentially, what you're trying to do is distribute a portfolio's assets based on someone's investment time horizon, their personal wealth goals, as well as their income and their risk tolerance. All asset classes behave differently, so determining which ones to go into is pretty key, and your risk tolerance plays a major factor in that. Just some of the main buckets to invest in obviously include stocks, bonds, mutual funds, ETFs, real estate, and then once you have lots and lots of money, likely alternative assets. So those are the three key decisions you need to make to start investing as a beginner in Canada. First, decide, do you need a financial advisor, or can you do this yourself with a robo-advisor or a self-directed account? Second, determine whether you're going with a TFSA or an RRSP. And once you max out those contributions, start going into the individual or margin accounts if you would like. And then determine your risk tolerance is the third key decision, which will feed into your asset mix or asset allocation. Okay, that's all I have for you guys today. I hope you guys did enjoy. If you did enjoy, don't forget to smash the like button, subscribe to the channel if you enjoyed the content, and I'll see you guys in the next video. Peace out.